Here's a number that should keep you up at night. $2.1 trillion. That's the total value of Africa's institutional assets, pension funds, insurance companies, and sovereign wealth funds. It's the continent's own money, accumulated from decades of workers' contributions and national savings. To put that in perspective, it's more than enough to close Africa's $170 billion annual infrastructure gap 7 times over. It's enough to build the roads, power plants, fiber optic cables, and ports that would transform the continent. That $2.1 trillion could build schools or pave roads. So if the money is there, why isn't it being used? Why are African retirees' savings financing European highways instead of Nigerian ones? This isn't just an economic puzzle, it's a scandal. And it's one of the single biggest obstacles holding Africa back. Welcome to Africa on Monday, your weekly YouTube channel simplifying African news and amplifying context to deliver insights that matter.
To understand this paradox, you have to understand the system that makes it more rational to invest anywhere but home.
Let's be clear, this isn't about a lack of patriotism. It's not about fund managers who don't care about Africa. It's about a system that is fundamentally broken. A system where it's easier, safer, and more profitable for an African pension fund to invest in a German government bond than in a Kenyan power plant. The numbers tell the story. Of the estimated $700 billion in African pension fund assets, the vast majority is locked in conservative, low-yielding assets. According to the African Development Bank, over 80% of institutional assets sit in government bonds and treasury bills, with minimal allocation to infrastructure. That's over $560 billion sitting idle, earning modest returns when it could be building the future. Meanwhile, Africa's infrastructure gap, the difference between what exists and what's needed, stands at $170 billion annually. That's not a theoretical number. It's hospitals that don't get built, roads that don't get paved, power plants that don't get constructed, and all the while, the money to fix it is sitting in bank accounts in London, New York, and Dubai. That $170 billion gap could build schools or hospitals every single year. This is the great paradox of African development. The continent is simultaneously capital-starved and capital-rich. The money exists, it's just in the wrong place.
So why is Africa's own money fleeing the continent? It comes down to 3 core problems. The first reason is the most understandable and the most frustrating. It's the law.
Pension fund managers have a legal fiduciary duty to protect their members' savings. Their job, their legal obligation, is to get the safest, most stable returns possible. And for decades, the safest bet has been to invest in stable, low-risk assets. US Treasury bonds, European blue-chip stocks, real estate in stable markets. Investing in a 30-year infrastructure project in Africa, on the other hand, is seen as a massive risk. What if a new government comes in and cancels the contract? What if the currency devalues by 50%? What if construction is delayed for years due to corruption or mismanagement? These are not theoretical risks. They are real, documented, and fund managers are legally bound to avoid them. So they do what the law requires. They invest conservatively. And conservatively means investing outside Africa. It's rational, it's legal, and it's devastating for the continent.
But even if fund managers wanted to invest in Africa, they run into the second problem: finding a project that's actually ready for the money.
For years, the excuse has been that there are no bankable projects in Africa. That's not true. The problem isn't a lack of projects, it's a lack of investment-ready projects. There's a difference. A bankable project is one that has done all the hard, expensive preparatory work. Legal due diligence, environmental impact assessments, financial modeling, risk mitigation strategies. Most pension funds don't have a team of engineers and project finance experts who can take a raw idea for a power plant and turn it into a 300-page investment prospectus that meets international standards. This is the bankability gap. There are thousands of good ideas, but very few have done the work to make them investable. This is where specialized firms like Africa 50 and ARM Harif are trying to bridge the gap, acting as trusted intermediaries between the raw projects and the big money. But it's slow, expensive work, and there aren't enough of these firms to meet the demand.
But the biggest, most silent killer of African investment is the third problem: currency risk.
Even if an infrastructure project is successful in local currency terms, devaluation can wipe out all the gains for investors. Take Nigeria. Between 2023 and 2025, pension fund assets fell by nearly 55% in dollar terms, not because of bad investments, but because of severe currency depreciation. Think about that. A fund manager could invest in a Nigerian role that generates a 15% annual return in Naira, but if the Naira loses 50% of its value against the dollar, the real return is a catastrophic loss. This creates a vicious cycle. Fear of devaluation drives capital flight, which weakens the currency further, which validates the fear. For a fund manager with a 30-year time horizon, it's simply more rational to invest in hard currency assets abroad. The math is brutal, but it's undeniable.
But after decades of capital flight, the rules are finally starting to change.
There is a growing recognition that the old rules are no longer fit for purpose. In 2022, South Africa amended its Regulation 28, which governs pension fund investments. The new rules allow funds to invest up to 45% of their assets in infrastructure, a massive increase from previous limits. This was a seismic shift, a recognition that the old rules were no longer fit for purpose. Nigeria is now reviewing its own rules, and other countries are watching closely. But this is a slow, painful process. It requires a complete mindset shift from both governments and fund managers. Governments need to create a stable, predictable environment for long-term investment, and fund managers need to build the expertise and confidence to invest in their own continent. The regulatory fall is real, but it's just beginning. And until it accelerates, the bulk of Africa's capital will continue to flow outward.
These regulatory changes bring us to the final battleground.
The battle for Africa's future will be fought not on the battlefield, but on the balance sheets of its pension funds. It's a fight to reclaim the continent's own capital and put it to work building a better future for its own people. This isn't about charity. It's about smart, long-term investment. It's about recognizing that the greatest returns of the next century will be found not in the saturated markets of the West, but in the high-growth markets of Africa. And it's about ensuring that when those returns materialize, they benefit the people whose savings made them possible. The $2.1 trillion is there. The question is whether Africa will use it, or whether it will continue to build someone else's future.
But the rules that keep Africa's own money from being invested at home are only half the story. What happens when foreign money comes in, but it's based on a fundamentally flawed perception of risk? To understand the invisible tax that costs Africa $75 billion a year, you need to watch this episode, The Racist Tax Costing Africa $75 Billion. Click the link on your screen to watch it now.